Welcome to Financial Reporting Conversations, brought to you by Basford Consulting.
We're here to make the unknowns and knowns of accounting, auditing and climate standards known, so you can avoid the blind-threading mistakes and do financial reporting better.
Each episode will unpack what the standards really say, what they mean in practice.
Whether you're a preparer, auditor, director or litigator, our aim is to help you get it right. Hello and welcome to Financial Reporting Conversations. I'm Judith Leung and as usual, I'm joined by Wayne Basford. Over the coming months, we're excited to launch our second WebBC webinar series covering some of the most challenging and most misunderstood areas in financial reporting and audit. So today we want to talk about what people can expect from these courses, why we chose these topics, and which sessions we're most looking forward to. For those of you who had joined our first webinar series last year, you'll realize our series aren't read the standard to you sessions. We focus on the things to watch out for that could lead to accounts being materially misstated. Where does this go wrong in practice? Where and what auditors are struggling with? And what are the complex judgment areas? So Wayne, you and I have sat down and brainstormed these 12 topics. These range from financial reporting failures, accounting and audit construction contracts and mining developers, US GAAP versus IFRS, auditing around the black box, and auditing in China, just to name a few. What made you brainstorm these topics?
Things that are interesting to me at the moment. So they really fall into about 4 categories. So what I'm seeing from file reviews, what I'm seeing from ISQM1 reviews that I'm doing, auditors not really understanding controls, not understanding IT, and, not really applying 315. Then we've got all the interesting accounting questions we get, accountants and preparers struggling still with IFRS 3, the concentration test, construction contracts, performance obligations in construction contracts, my personal frustration on reading incorrect deferred tax notes. And there's practical stuff I'm working with clients, how to actually report to a US parent. You've been acquired by a US parent. How do you actually communicate with that parent? And how does the auditor give assurance on the reporting pack? And of course, always, or unfortunately, for front of some of my stuff is audit failure and litigation. So trying to share some of the issues I'm seeing and hopefully people learn from those issues.
So hopefully that gives people a bit of a taste and a bit of flavor what's coming up. What do you think makes our sessions different to others?
Well, hopefully they're practical. As you've known me for years, if I ever want to be a lecturer, if I wanted to be an accounting professor and put leather patches on my suit jacket, that's never happened. I do not intend to teach people how to pass CA, teach people theory. Everything I want to do is practical for preparers, practical for auditors. And emphasizing to anybody listening to this on Spotify or listening to this on YouTube post June 26, the big thing that we're improving this year is there's online versions of these topics. So I'm skeptical really of the webinar. No matter how well I present on a webinar, will people remember it? Is it accessible? So for this season of webinars, there's going to be backup iSpring courses. So going forwards, any of these courses are going to be available online. And, this is this concept of rather than just in case training, it's just in time training. So anybody that suddenly gets a problem with how do I report in US GAAP or how do I deal with top hats and new business combinations, concentration tests, there's going to be iSpring courses that they can log into and refresh themselves on.
Yeah, and really sort of embed that learning, because a lot of times when we are listening to a webinar, we're just listening and being a passive learner rather than, our iSpring courses are designed to be sort of more of an active learner, different. You've got stuff to read, you've got stuff to watch, and you've got a quiz to sort of review and on the knowledge to make sure that it sort of really goes in.
Me and you, we have traveled the world lecturing IFRS. We have lectured in KL. We have lectured in Beijing. I've still got pictures of me and you climbing the Great Wall, having lectured IFRS in China. And although for us it was good, I'm never been convinced that for the people watching, they took it in. I send them away with big A4 folders of notes and slides, and it's just too difficult to read. So this face-to-face delivery, even the webinar delivery, it's useful to make notes. It's useful to, I need to think about that. I need to think of that. But definitely, the world we live in and the world's improved, we've got iSpring courses. And so all of these topics, as people get confused with the concentration test, top hats, construction contracts, the ability for a partner to look it up on their phone or even a senior to look it on a phone, I think that's making our product unique at the moment.
Yeah, absolutely. Yeah, let's go back to the BC webinar. So for this series, that's what we're here to talk about.
And iSpring courses.
Yes, and iSpring courses. We opened the series with financial reporting failures, Central, Slater & Gordon, Wirecard. Why are we starting there?
One of my frustrations and driving for audit quality, we don't learn from mistakes. If a 737 falls out the sky, it is fully investigated, and the reason it fell out the sky is communicated. I know it's something to do with the autopilot and stalling when it's in a certain angle. And we all learn from 737s falling out the sky. And hopefully, as somebody who travels on 737s, we're going to learn from it and it's not going to happen again. We should be learning from financial reporting failures and apparent audit failures. But it's hushed up. The auditors typically deny it. It wasn't wrong. There was nothing wrong. Well, we've ended up in a situation where there's challenging on an audit opinion. Something's gone wrong, but we don't talk about it. There isn't any published analysis in acuity, in the black. So this is trying to share what were the key features of these matters. And for hopefully everybody that's attending this can ponder it and just think, I might have done that. I can see how that audit partner missed that. Note to self, when I'm doing my audits, when I'm planning my audit, I'm not going to repeat the errors that were made in that matter. And equally, those sessions, it's not just for auditors. They would be ideal for directors, audit committee members, and preparers. So it should be a fun session.
It's like a learning and educational while we're opening them up and while we're talking about it. It's not to sort of blame anyone. It's more to learn from those mistakes and hopefully.
The number of the matters I look at, I think, there for the grace of God go I. I can see how it happened. I can see the audit partner got too distracted with a certain risk, which is one of mine, that got distracted with a certain risk and missed that one. You can see in horrible situations, the audit partners just put in a ridiculous amount of pressure to sign. The client's not given the information that they've asked for. They continue to ask for it, but ultimately there's real bullying from the client to potentially get the unmodified audit opinion at the same time, out on time before the 30th of September. So, this is a learning thing. This is not meant to be in any way accusatory, though. In all fairness, the Wirecard one, looking at what went on in Germany, looking at bank confirmations in Singapore, that might be an interesting one to consider.
Yeah, I'm pretty sure, we'll save the details for the actual course. We'll leave some suspense.
remembering I've yet to write all of that course or finish it. Certainly I've not finished writing the Wirecard section.
From financial reporting failure, we move on to understanding the control environment. That's the next course. One question you're going to tackle there is, can an auditor truly adopt a fully substantive approach when controls are weak? So can you tell us a bit more why you're tackling that issue?
It's just one of my frustrations, this idea, and I hear it's from so many auditors, and I see it documented on so many audit files. We do not need to understand controls because we adopt a fully substantive approach. It's almost a complete fallacy in that there are just the concept of audit. There are certain aspects, there's certainly assertions, you really need to rely on controls. Looking at completeness, how do you know? How can you substantively test accruals and liabilities are complete? You really need a system that gets the correct accruals and liabilities. How can you test complex calculations, payroll calculations, rebates? You're relying on something to calculate hundreds of transactions correctly. How do you substantively do that? And then, of course, the actual auditing standards say for a significant risk of material misstatement, you have to identify and evaluate the controls that should be in place to address that significant risk of material misstatement. So, this idea, I do a fully substantive audit approach, I don't need to look at controls, doesn't make sense. And by the way, the most traditional audits, we look at controls. We are desperate for bank reconciliations. We expect stock takes to be done. We expect there to be aged debt reviewed and aged inventory reviews. If we walk in and find the bank rec doesn't reconcile, we freak correctly because it increases the risk. But having a bank rec that works, that hasn't got reconciling items, is actually, we're looking and relying on the control. So hopefully, rather than me trying to explain to audit partners again and again, it will be, please go and watch this course.
Yeah, so that's on controls for the auditors. And our webinars are not just for auditors. We also have, they are also designed for accountants and people in the finance function within an organization. So let's move on to some accounting topics that we're going to look at. We've had quite a bit of feedback asking for more industry-based training, particularly in revenue. So we're running a session focused especially on long-term construction contracts under WSB 15. These contracts are complex and they often run over several years and may include design, construction, and in some cases, maintenance components. And so some of the key issues we'll be looking at are design and build separate performance obligations or they're one combined obligation? How do we deal with variable consideration like delay penalties and performance bonuses? Is there a financing component, particularly where milestone payments are spread over a number of years? And how do we calculate the transaction price? And how should revenue be recognized for each of those obligations? Is it going to be over time or a point in time? Interestingly, when in our last training session, we didn't receive many questions on contract modifications, even though they are very common in the construction industry and one of the many complex areas of 15. What are your perspective on some of the pain points when we're dealing with this topic? I know you have a lot to say, but be brief and we'll leave the details for the actual training session.
Thanks, Judith. Be brief. For everybody that's applying construction accounting, we're applying AASB 15. We need to identify the performance obligations and we need to work out whether the performance obligations are distinct. Most likely, design and build are not distinct, even though we'd love to recognize as much revenue as we can early on. And we recognize revenue based on the relative selling price of the performance obligations. We do not recognize revenue based on that front-loaded billing schedule contained within the contract. Other key features in IFRS 15, uninstalled materials. We need to identify uninstalled materials, and it changes profit. it is not the POC that we've always used. And you're touching on variable constraint. We live in a world of the reversal constraint. Reversal constraint and construction contracts is there. Cost overruns, penalties, variances. It's all in AASB 15. It's all in these construction contracts. We're seeing so many companies trying to push the envelope, and it causing audit risk. When one of these construction contracts goes wrong, when it turns out into an owner's contract, people are going to ask questions, and people are going to ask questions horribly more of the auditor than actually the preparer.
If you're finding this discussion useful, please take a moment to click like, subscribe, and share. It helps others in the financial reporting community discover financial reporting conversations and keeps you up to date with every new episode. Thanks, Wayne. So looking forward to that session. Let's move on to another accounting topic, one of my favorite, AASB 9, and where things can go wrong. And we're still seeing quite a lot of errors in practice, despite the standard being around for quite a while now. And most people, what I've found nowadays is that they've understood the fix for fix test, which is good. So when it comes to classifying convertible instruments, people are better at saying, no, that's not equity. It's a liability or derivative liability. But what I'm seeing in practice is people are struggling with is the actual accounting for it, particularly trying to understand applying the effective interest rate and then working what happens on conversion. As a convertible note, if it converts to shares, it sometimes may not just be you debit your liability and credit equity, assuming that they have already gotten the carrying amount of the liability right. But a lot of cases, they haven't measured the liability correctly. And there's also a bit of confusion about modifications, particularly with convertible notes, but modifications just on debt can get quite complex. And more broadly, I'm still seeing classification errors around financial assets and confusion around what used to be the available for sale financial assets category under AASB 139, which no longer exists. And there's a new category called fair value through OCI under AASB 9. But there seems to be a misconception because that is a very different category in both in terms of the classification requirements into how you get into the category, as well as the accounting. So we're going to look at that. This session is going to step through these common areas and clarify how AASB 9 should be applied in practice. Wayne, let's move on to the two other accounting topics that we have. AASB 3 is a business and a mining focus session. Again, why are we covering these two topics?
In terms of IFRS 3, it's all the questions and people possibly getting confused or definitely pushing the envelope. Preparers want most typically to have an asset acquisition. It's a lot easier. It deals with the deferred consideration. You don't have to do deferred tax. So preparers really want to get an asset acquisition. They've now discovered, they've read this description of the concentration test. So if I can pass the concentration test, I've got an asset acquisition. And as you know, people are getting confused and with the concentration test and missing the key principles behind it. So hopefully this session will clarify some of those misconceptions. And the other one, this is jargon. Me and you, we throw in the phrase top hat, but the Australian world is company A acquires company B. That's an acquisition. Company B is a business. It's a business combination. Ignoring the fact that company A was set up to acquire company B. Now, in our terminology, it's a top hat. And hopefully this will talk through preparers and auditors how to recognize top hats and then how to account for it. In the mining one, the simple one is I live in Perth, so I should be writing courses about mines and opening mines. Good news is because of the price of gold, because the price of silver and zinc, a lot of mines have been opened up quite quickly. And the accounting's complicated, stripping costs, identifying leases, moving from out of the Great Shield of IFRS 6. And that's on the positive side of why I'm doing it. And going back, one of the reasons I'm writing these courses is as a byproduct of some of the litigation I see. Unfortunately, a lot of mines that are trying to go into production don't. They fail, they go under, creditors lose money, shareholders lose money. The audit opinion wasn't appropriately modified. So it is going through, when single asset developers go try and get into production, there's all sorts of audit risks with it. So it's trying to remind preparers and auditors it can be a risky business.
We've got another old friend as an accounting topic, WSB 112 deferred tax. Now, that's a very old standard and has not changed. People should understand it pretty well. And since it has been around Australia, since Australia adopted IFRS 20 years ago. Why are we still running a course on 112?
You're holding me back from me writing the article that says 20 years on, AGAP is still alive. And if you want an instance of AGAP is still alive and we've not learned since 2005, I still have temporary differences, permanent differences. If I talk to the tax guys, they just do tax returns. And we review all these notes. We review the deferred tax note that have got permanent differences, timing differences, amazingly unbelievable reconciling items to try and get the tax to balance. So I still think IS 12 really hasn't properly been adopted in Australia 20 years on. And, you mentioned the wonderful world of AF available for sale. It's quite interesting that the Australian accountant quite grasped this idea of available for sale is a bucket category under IS 39. IFRS 9 was adopted in 2018. And me and you are still seeing accounts with available for sale in them. So the world does need to move on, but it doesn't move on that well.
Yeah, so that's a bit of a taster of some of the accounting topics we have. Circling back to auditing topics, we've got a topic called auditing around the black box. Why did you pick this topic?
Now, again, it's partly through frustration of having talking with audit partners, and it follows on from this idea. I don't look at controls. I do fully substantive audits. I'm looking at a number of situations where the black box, the computer, makes amazingly complex calculations. And, this can be just in terms of payroll, just in terms of wages, deductions, overtime, super, etc. Or it can be very complex revenue areas. And I'm looking at the audit files and there's nothing on the IT system or the risks that come about from the IT system. I'm looking at one set of audit files and this is not just one isolated one, whereby we've got an acquisitive group that they've been acquiring subsidiaries, components all around Australia, all around the world. The file correctly says we use 5 different computer systems to recognize revenue, to calculate revenue. But that's all it does. It doesn't think there might be a risk of material misstatement because the computer system's not calculating things that it should. Or there might be a risk of material misstatement because we're not downloading the information, we're not integrating the information. And there really could be a risk of material misstatement because it's all held together in Excel. It is one of those things. Auditors adopt a very interesting it's in a black box. Don't you worry. I will somehow ignore the black box, but whatever comes out of it is bound to be right. And it's trying to talk through explain to auditors their obligations to consider the risk of material misstatement arising from an IT system.
That's interesting one. So I'm not an auditor, but one audit session I'm looking...
Judith, you're not interested in any audit matters at all. You know, this is, you've denied ever wanting to be an auditor. You know, this is, there are the Judith interesting, this is financial instruments, this is what fair value through OCI means, but all this audit stuff, you can't pretend to the listeners that you're at all interested.
No, one
You might be sympathetic.
Well, I am interested in, because it's linked to my heritage, is this auditing in China, the China Hustle. There's a movie called The China Hustle. If anyone hasn't watched that movie, I should strongly recommend you watching that movie. It's on YouTube. It's for free now before this session as a pre-work.
Yeah, and the title is The China Hustle, and for anybody that's considering, I can go and audit these entities that are listing on the ASX or listing somewhere else, but they're mainly based in China. Before you accept that audit, please watch The China Hustle. And I've signed a file. I have audited lots of companies in China. I have seen lots of frauds. I have seen people lie to me. I have seen situations of definitely false sales, false invoices, false bank confirmations. I audit in China. I do a debtor circ. I amazingly get 100% confirmation. And there are never any reconciling items. There are never any disputes as timing or pricing. So I file it and think that gave me no audit evidence at all. Fortunately, and I remember I strongly believe that there should be great links even in the capital markets between China and Australia. And I'm getting lots of calls from audit partners saying, I hear that you've done a lot of work in China. I'm getting approached to take on these audits. What do you think? And it is, beware. It's a scary place. But for anybody that's looking at dealing with components in China, I strongly recommend that they go through. These are what actually happens up there. And by the way, these are the audit procedures that you should do to determine whether it's real or not. And you're auditing in a completely different environment.
Certainly. I think growing up, my dad has an importer business in China, so I do hear a lot about the familiar with the business environment in China, and what I hear from Wayne doesn't surprise me.
It was explained to me genuinely that you need to understand that doing business in China, there are lots of links in the chain, and every link of that chain has to be oiled. And where you get your raw materials from, who your actual customers are, it's an interesting concept. But literally, if you look at look at the China Hustle, look at the largest listed plantation. It was a bamboo plantation, listed on NASDAQ, audited by one of the big four. And the only problem was the plantation didn't exist. But it took them about 5 years to realize the plantation didn't exist. So it is almost, it should be audit boot camp. Go and try and audit in China, and your level of professional skepticism will increase.
And so linked to that, we also have a separate session on why audits go wrong. What are you hoping to cover in that, Wayne?
Now, this is distilling part of the stuff of the litigation or the big cases, and part of the stuff that's coming out of what I'm seeing on ASQM1. And, you know, there's a common pattern that, giving away the content of the course, auditors take on audits they shouldn't do. They haven't got the resource to do it. They haven't got the time to do it. They haven't got the budget to do it. And then coupled with that or alongside it, they really just don't understand the business. They don't have the time or the intellect to properly understand the business model. And then if you don't understand the business model, you don't, with enough specificity, identify the risk of material misstatement. This is all linked with nobody's skeptical. Nobody wants to say that something could go wrong. Typically, in a lot of cases, the problem is identified, but it's typically identified too late. And going back to what I was saying, with the audit failures, it's common issues. You're pressurized to sign. Why didn't you ask for this earlier? I gave you this before. You didn't tell me. You never mentioned this. Do you realize the consequences of us getting suspended? And, it's trying to go through the common issues I see in audit failures and, again, share that with the audit partners so they can ponder it and build it into their own procedures.
Thanks, Wayne. Let's wrap up today. I know we've got a lot of topics and there are other topics we haven't discussed that you're looking forward to, the one on US GAAP divided by a common language. And it's called our series, just like this podcast, has one purpose, is to help auditors and accountants do financial reporting better. Many of the issues we see and we've discussed in this podcast today aren't new. On the standards themselves aren't new or unknown. Some of them, like the IAS 12, has been around for 20 years. But a lot of times people assume they understood the standard, but they actually don't or are not applying it correctly. Auditors and accountants need to understand how the standard actually is meant to be applied, how it works, where it can go wrong, and how to, for auditors, challenge your client's assumptions. And so that's what our series is really about, helping professionals ask better questions, think more critically, and challenge more confidently if you're an auditor. So thank you for joining us for this episode of Financial Reporting Conversations. If you're interested in the webinar series, we'd love for you to join us, whether for one session or for the full series. Go to basfordconsulting.com and click on the training tab and you'll see a link to the webinar series.
For anybody that's watching this in June 26 or has clicked on an episode in October 27, please look at this on the iSpring. So all of these topics will actually be more detailed. There's more ability to cover these topics in the iSpring courses. So it would be great for everybody to look at the webinars and to be there at the webinars, and please ask questions at the webinars. But the real value, I think, is actually looking at the iSpring. And if anybody's got topics they think we've missed that are worrying them, that they've been pondering and know they don't understand or know their teams don't understand, drop us a line and the chances are we'll be grateful for that positive feedback. Where did some of these courses come from? Yeah. They actually come from their clients. They come from a lot of our audit partners saying, I don't understand this. So the more questions we get, the more practical our stuff will be. So
thanks again, everyone, for joining. And we hope to see you at some of our training and our next financial reporting conversations.
Thanks, Jude. Thanks for listening to Financial Reporting Conversations. For guidance on applying accounting and auditing standards or to access our online training programs, please visit basfordconsulting.com.
Don't forget to like, subscribe, and share this episode with your colleagues and contacts. We'll see you next time where we make the unknowns in financial reporting known.